In this era, overwhelmed by information, the trader's greatest enemy is no longer market uncertainty, but information overload. Thousands of news reports, analyses, data points, and indicators flash before your eyes daily, each claiming to hold the truth about the market. And the result? You become hesitant, sluggish, miss opportunities, and ultimately get consumed by emotion and left behind by the market. Jesse Livermore warned us over a century ago, thinking too much leads to inaction. This isn't some hollow proverb, it's a vivid truth that every seasoned trader has experienced firsthand. Let's begin with a true story. In March 2022, the Federal Reserve announced expectations for rate hikes, triggering turbulence across the US stock market. Retail traders scrambled across social media, financial news, and chat groups, hunting for every possible data point in employment figures, inflation metrics, CPI forecast 7 passing the facial expressions of Fed officials. Yet while the masses waited for a clear signal, true winners were already quietly increasing their positions in high-yield defensive sectors like US energy stocks and gold ETFs, preparing to ride the breakout once the trend confirmed itself. This is the survival rule: under information overload, action beats explanation, and understanding the trend matters far more than understanding every single news headline. Follow this channel. We'll keep diving deeper into the core mechanics of trading psychology. Stop asking where the market is headed. Start asking whether you are ready to face any direction it might take. True trading intelligence isn't about assembling a jigsaw puzzle of information, it's about cutting through the noise and seizing the key moment. Livermore called this the key point trading method. He didn't try to predict every wiggle. Instead, he struck decisively at the moment the trend truly ignited. He would patiently wait, watching whether a stock could break through prior consolidation, whether it came with volume, whether a clear sector leader was emerging. When those criteria aligned, he didn't hesitate. He understood that the essence of trading isn't about guessing, right? It's about betting at the key moment. And this means you must abandon the fantasy of complete information. Great traders never pursue comprehensiveness. They pursue clarity in execution. For example, in 2020, in China's A-share market, before the EV, new energy vehicle sector took off, most traders focused on policy incentives and earnings reports. But a few trend followers honed in on just two signals: increased sector correlation and BYD's sustained volume-led surge. They weren't seeking validation, they were seeking execution. Remember this truth: information is not for confirming your belief, it's for invalidating your mistakes. If you want to break free from the paralysis of over-analysis, you must first build your own trading philosophy framework. It doesn't have to be complex, but it must be solid. It must answer 3 questions. What do I define as a trend? How do I determine its validity? What are my action rules once a trend begins? In Livermore's systematic trading approach, the structure was crystal clear. Identify the major trend, wait for confirmation, open a small test position, add on trend continuation, exit with strict stop losses. This structure helped him win repeatedly in both the US stock and gold futures markets. What you need isn't more data, it's firmer execution. If you spend 3 hours daily consuming financial news, analysis, videos, and chatroom debates and come away with more doubts than conviction, that's anti-trading behavior. Effective information gathering is more about filtering than collecting. Livermore focused only on the key sentiment drivers like sudden interest rate shifts, explosive earnings, surprises from market leaders, or major geopolitical policy moves. He wasn't swayed by noise. He knew that every extra variable was corrosion to internal conviction. When it came to trend recognition, Livermore emphasized, time is more important than price. Take a real-world example: gold in 2023. Prices rose from $1,800 to $2,050 per ounce. Many traders obsessed over every pullback. But the successful ones focused on trend duration. They understood If gold stayed above a key moving average for 12 straight sessions without major violation, that was a trend. Continuity of behavior was a more important signal than raw price movement. If you want to survive long-term in such a market, you must master money management. Livermore confessed that his most painful losses didn't come from wrong analysis but from position sizing failures. When he bet heavily before the trend confirmed, a small shakeout kicked him out. But once he adopted the pyramid add-on strategy heavier positions with trend confirmation, he became a disciplined trader. He would start with an initial position after a key breakout. If the trend continued, he'd add half. If strength persisted, he'd add a final tranche. Losses remained controlled if wrong, but if right, profits compounded like a snowball. We cannot avoid the emotional challenges in trading. Greed, fear, regret, and anxiety, these human weaknesses often cause you to act when you shouldn't and hesitate when you should persist. Jesse Livermore documented every single trade in his trading journal, recording entry reasons, market conditions, emotional states, and the differences between plan and execution. This habit allowed him to objectify his subjective emotions. You should build such a system today, not to prove yourself right, but to weaken the power of emotion. Have you ever felt this way? Before entering a trade, your plan was crystal clear: stop loss, scale-in points, and exit strategy, all well defined. But once the price starts to move, your mind begins to sway. You intended to open a small position, but suddenly you can't resist going heavy. You set a stop loss, but as the price nears it, you cancel the alert. You know it's wrong, yet you can't stop yourself. Why do we betray our own frameworks? Why do we fail to be ourselves in front of the market? Jesse Livermore once pointed out a critical truth. The market is never wrong, people are. This is not a rebuke, but guidance. It tells us, if you can't manage your emotions, you can never manage risk. If you can't view yourself objectively, you can never become a professional trader. How do you objectify your subjective emotions? The first step is to break trading into structured behaviors. Livermore's approach is worth emulating. Before any trade, he would predefine 3 conditions. Does the market structure support the direction? Is the stock or commodity within a trending channel? Is my current mental state stable? Only when all 3 conditions were met would he allow himself to proceed. What's even more valuable is that after each trade, he would do an emotional review, not of the market, but of his inner world. He would write, was I impulsive today when entering the position? Was this driven by fear, jealousy, greed, or calm logic? This subjective logging system was the key tool he used to develop cold, rational judgment. You can't eliminate emotion, but you can make it measurable. Here are a few practical methods. Emotion scoring. Before market open, rate your anxiety, confidence, and fatigue levels. If any score exceeds a threshold, no trading. Written reason rule. Before placing an order, write down 3 non-repetitive, logic-based entry reasons. If you can't write 3, don't enter. 24-hour cooling rule. For any trade idea that excites or terrifies, you wait 24 hours before re-evaluating. Emotional backtesting. Tag each of your past 3 months' trades by emotional state: impulsive, fearful, methodical, and analyze which ones were most profitable. True emotional separation isn't suppression, it's structured output. You must give your emotions an outlet, rather than letting them leak into every trade. Livermore once said, a trader's greatest asset is not his account balance, but his level of self-understanding. He even kept a note taped to his trading desk. If I'm not in the right state of mind today, shut down all market software. That's the ultimate form of discipline and a higher form of self-respect. You may never fully eliminate emotions, but you can design a system to make them quantifiable. In practical trading, here are several methods worth adopting. Emotion scoring system. Before each trading day, rate your current emotional state, 1 to 5, for anxiety, confidence, and fatigue. If any score exceeds your threshold, no trades. Forced reason writing. Before every order, Write down 3 logical, non-redundant reasons for the trade. If you can't come up with 3, don't enter. The 24-hour cooling rule. For any trade idea that makes you feel overly excited or scared, enforce a 24-hour cooling period before reconsidering. Emotional backtest analysis. Go back over the past 3 months of trades and label each by emotional type: impulsive entry, panic exit, or planned execution. Then, analyze the P/L by type. You'll be shocked to discover the most profitable trades usually aren't inspired ones, but boring repetitions. Let's look at a classic example from China's A-share market. In early 2021, the pharmaceutical sector soared. Many traders chased the high only to panic sell weeks later during a steep correction. In contrast, those who followed emotion scoring plus key point entry systems waited patiently for structural breakouts, confirmed by low-volume, golden cross patterns. They managed position size with discipline, and even when the sector retraced, they exited quickly. This wasn't a victory of technical sit, was a victory of emotional systemization. When you learn to objectify and visualize emotion, trading stops being chaotic. It reveals a clear rhythm and structure. And that rhythm is the essential survival skill of every professional trader. You are no longer dragged by candlesticks or controlled by P/L swings. You operate like a surgeon, executing with precision under emotional neutrality. Livermore said, "A trader's greatest asset is not the money in his account, but the depth of his self-understanding." That quote remains powerful today. In a volatile, noisy market, if you can't control yourself, you don't deserve to control capital. Here's a principle I live by. Until you can control yourself, don't try to control the market. True masters of trading don't win 10 times a day, they win 10 times a year. And every time, they do so at their clearest, calmest, most stable moment. If you've read this far without feeling lost, you're already ahead of 90% of traders. Because you've realized that real trading skill isn't about absorbing all information, it's about discarding the irrelevant and executing with focus. It's not about chasing trends, it's about acting based on structure and logic. Trend following remains the only eternal principle in the trading world. Next time the market shakes, the headlines scream, and the chat rooms roar, come back to these 3 basic questions. Is the trend clear? Are key price points confirmed? Is my plan well defined? Only when all 3 answers are yes should your capital be put to work. Any other time, your best move is always the same: wait. If this content inspired you, don't forget to subscribe and hit the bell. We'll keep delivering actionable trading value. From the key point strategy to position sizing frameworks, from emotional isolation tactics to the golden momentum wave model, each episode is another brick in your personalized trading system. On this path full of temptation and traps, the only thing you can truly rely on isn't the market, isn't the analysts. It's your own system, forged through discipline, clarity, and control. Jesse Livermore built his. You can build yours.